Passive income is real. People genuinely do build financial systems that generate money without their direct ongoing labor. But I need to tell you something directly before we get into the 7 streams, because what most people have been told about passive income is either incomplete, misleading, or designed specifically to sell them something. Here is the uncomfortable truth, that the passive income industry, the courses, the influencers, the YouTube thumbnails, showing people on beaches with laptops, almost never shows you. Every single genuine source of passive income requires either significant capital upfront, significant effort upfront, or both. There are no exceptions to this rule. There has never been an exception to this rule. And anyone presenting you with a passive income opportunity that requires neither capital nor sustained effort is either selling you a fantasy, running a scheme, or both. The reason this matters is not to discourage you from building passive income. You absolutely should. And this video is going to show you how. It matters because the gap between what most people expect passive income to look and feel like and what it actually looks and feels like during the building phase is one of the primary reasons most people who try to build it give up before they ever reach the point where it genuinely becomes passive. They start with energy and optimism. They do not see the fast results they expected. They conclude that passive income does not work, or is not for them, or requires something they do not have, and they stop right before the point where the sustained effort or accumulated capital would have crossed the threshold into genuinely producing the income they wanted. This video is going to close that expectation gap completely. For each of the 7 income streams we are going to cover, I am going to tell you the full truth. What it actually requires to build it, what a realistic timeline looks like, what the realistic income potential is at different stages of development, and what the specific concrete first steps look like for someone starting from where most people actually start. No hype, no inflated income claims designed to make you click, no course to sell at the end. Just the direct, honest picture of 7 genuine ways to build income that does not depend entirely on your direct ongoing presence, and what each one genuinely costs to build. If you want the real picture of passive income, how it actually works, what it actually takes, and how to actually build it, this video is exactly that. Let us get into it. The one rule that never changes before we go through the 7 streams. Let me establish the foundational rule of passive income clearly, because understanding it changes everything about how you approach building it. Every source of passive income is built on one of 2 foundations, capital or effort. There is no third option. Capital-based passive income means deploying money into assets that generate returns, dividends from shares, rental income from property, interest from lending instruments. The income, once the capital is deployed, requires minimal ongoing involvement. It arrives consistently and predictably, but the capital required to generate meaningful income at this level takes time to accumulate. At a 4% dividend yield, generating $1,000 per month in passive income requires approximately $300,000 invested. That is the capital foundation required for that income level. It is real money, and for most people, it takes years of consistent saving and investing to accumulate it. There is no shortcut around the capital requirement. Effort-based passive income means creating something once, a product, a system, a content library, business model that continues generating income with significantly reduced ongoing effort after the initial creation work is done. The income can be genuinely passive once the system is established, but the upfront effort required to establish it is real, sustained, and significant. A digital course that generates sales while you sleep required weeks or months of intensive work to create. A YouTube channel generating advertising revenue from older videos required years of consistent content creation to build. The income is passive. The building of it absolutely was not. Understanding which foundation each stream requires, and being honest with yourself about which foundations you currently have or are willing to build, is the most important preparation for building passive income successfully. Choosing a stream that requires capital you do not have and cannot accumulate in a reasonable timeline is not a strategy. It is a source of frustration. Choosing a stream that requires sustained upfront effort, but you are looking for quick income will also end in frustration. Match the stream to your reality. Build it with accurate expectations. Give it the time it requires. That is the formula. Dividend investing. Most accessible. Most reliable long-term dividend investing is the most straightforward, most scalable, and most reliably documented source of passive income available to anyone with an investment account and a long-time horizon. The concept is simple. Buy shares in companies or funds that distribute a portion of their profits to shareholders on a regular basis, typically quarterly or annually. Those distributions arrive in your account without any action required from you. You do not have to manage tenants, create products, build an audience, or do anything beyond maintaining the investment. The income is genuinely passive in the fullest sense of the word. The challenge, and this is the part that prevents most people from building significant dividend income, is the capital requirement. The income a dividend portfolio generates is proportional to the capital invested. A broadly diversified equity portfolio, generating a 3 to 4% yield annually, produces $300 to $400 per year on $10,000 invested. On $100,000, $3,000 to $4,000 per year. On $500,000, $15,000 to $20,000 per year. Meaningful passive income from dividends requires meaningful invested capital. And meaningful invested capital takes time and consistent investment to accumulate. This is not a reason to dismiss dividend investing. It is a reason to start building the capital base now. Because the portfolio that produces meaningful dividend income at 55 or 60 is being built by the contributions and compound growth of the next 2 decades. The time to start is not when the capital base feels adequate. The time to start is now when the compound growth has the maximum amount of time to operate. Consider an investor who begins contributing to a dividend-focused index fund at 28 years old. Their contributions are modest, whatever their budget allows after essential expenses. They reinvest every dividend automatically, so the dividend income compounds back into the portfolio rather than being withdrawn. For years, the dividend income in absolute terms is small. At 35, it is perhaps a few $100s annually. At 45, with a larger portfolio from years of contributions and compounding, it is several thousand. At 55, the combination of a substantially larger portfolio, decades of dividend reinvestment, and the compound growth of everything that came before produces an income stream that, while it started from almost nothing, has grown into something genuinely significant without ever requiring the investor to do anything beyond maintaining their automatic contributions. One critical distinction in dividend investing: there is a significant difference between a high-quality dividend from a financially strong, consistently profitable company and a high yield from a financially stressed company where the dividend is unsustainable. A 10 or 12% dividend yield from a struggling company is not more attractive than a 3% yield from a financially excellent business. It is more dangerous. High yields are sometimes a sign of distress, not generosity. The stock price has fallen because the business is struggling, which makes the yield mathematically higher, but the dividend itself may be cut imminently, taking the income and the capital value with it. Always prioritize the quality and sustainability of the business over the size of the yield. The most effective approach to building long-term dividend income for most investors is not selecting individual dividend stocks, which requires significant analytical skill and time commitment, but investing in broadly diversified, low-cost dividend-focused index funds or total market index funds that include dividend-paying companies. This approach captures the dividend income, provides the diversification that protects against any individual company failing, and does so at a minimal cost that preserves the maximum proportion of the yield for the investor. Model action. This week, if you do not already have an investment account, open one. Research a broadly diversified global equity index fund or dividend-focused ETF with a low expense ratio. Set up a regular automatic contribution, however small. Enable automatic dividend reinvestment. The dividend compounding engine has now started. Every contribution and every reinvested dividend builds the capital base that grows the future income stream. Rental property income, capital-based, leverage-enhanced. Actively managed rental property is one of the most powerful wealth-building vehicles available, primarily because of the leverage effect that allows a relatively modest deposit to control a significantly larger asset. But it is also one of the most commonly misunderstood sources of passive income. It is often far less passive than people expect. The fundamental model is straightforward. You purchase a property, typically with a mortgage covering the majority of the purchase price, and rent it to tenants whose monthly payments cover or exceed your mortgage payments, property taxes, insurance, maintenance, and management costs. The surplus above those costs is your net rental income. The property itself may also appreciate in capital value over time, adding to your total return. And the mortgage balance declines with every payment, progressively increasing the equity you own in the asset. The leverage effect is what makes property particularly powerful as a wealth-building vehicle. If you invest $50,000 as a deposit on a $250,000 property, and the property appreciates 5% in a year, the capital gain is $12,500. That is a 25% return on your $50,000 investment from a 5% appreciation in the underlying asset. The leverage amplifies the return on invested capital dramatically in the upward direction when markets are rising, and equally in the downward direction when they are falling. Leverage is a multiplier. It works in both directions with equal force. Now here is what most passive income content about rental property does not tell you directly enough. Rental property is not passive income for most small landlords. It is a second job with irregular hours, unpredictable workload, and no guaranteed wage. Finding and vetting tenants takes time. Managing lease agreements, maintenance requests, and repairs takes time. Dealing with vacancies, periods when the property sits empty and the mortgage still needs to be paid, takes time and costs money. Even with a property management company handling the day-to-day operations, the oversight of that company, the financial management, and the strategic decisions are your responsibility. Think about the person who buys their first rental property expecting genuinely passive income. The first few months go smoothly. A good tenant, rent arriving on time, minimal maintenance required. Then the boiler fails. Then the tenant leaves and 2 months pass before a new one is found, 2 months of mortgage payments with no rental income to offset them. Then a repair dispute requires time and potentially legal advice to resolve. None of these are exceptional events. They are the normal operational texture of owning residential rental property. The income is real. But for most small landlords, the management requirement means it is best described as semi-passive rather than genuinely passive. None of this means rental property is not a worthwhile investment. For many people with the right circumstances, sufficient starting capital for a proper deposit and contingency fund, appropriate time for management, a property in a market with genuine rental demand, and the temperament to deal with the operational realities, it is an outstanding wealth-building vehicle. The leverage effect, the rental income, the mortgage reduction, and the capital appreciation together can produce returns that equity investment simply cannot match. But it should be entered with accurate expectations rather than the fantasy of effortless passive income. The capital requirement for responsible property investment is substantially higher than the deposit alone. In addition to the deposit, typically 15 to 25% of the purchase price. A property investor needs a meaningful contingency fund for unexpected repairs and maintenance, a vacancy fund to cover mortgage payments during periods without rental income, and sufficient disposable income to service the mortgage comfortably if rental income is temporarily disrupted. Entering property investment undercapitalized is one of the most common sources of financial distress in real estate. But action. This week. If rental property is a path you want to pursue, calculate the full capital requirement for a property in your target area. Deposit, purchase costs, contingency fund, and vacancy reserve. Be honest about whether that capital is accessible to you on a realistic timeline. If it is not yet accessible, focus on building it through dividend investing while preparing your knowledge of the property market you intend to enter. Index fund portfolio withdrawals. Capital based. Most flexible to total return approach this stream is perhaps the most underappreciated source of passive income available to individual investors, and the one that most financial education overlooks because it lacks the narrative appeal of property or the aspirational quality of content creation. The total return approach to passive income is simple. Build a broadly diversified investment portfolio, primarily equity index funds, over a working lifetime of consistent contributions. At the point of financial independence or retirement, begin withdrawing a small, sustainable percentage of the portfolio annually, typically 3 to 4%, to fund living expenses. The portfolio invested in assets that historically grow at a rate above that withdrawal percentage continues to grow even while income is being drawn from it. At a 4% withdrawal rate, on a portfolio of $1 million, the annual income is $40,000. The historical evidence suggests that a diversified portfolio can sustain this withdrawal rate indefinitely across virtually all historical 30-year periods, meaning the portfolio does not run out, and in many scenarios actually grows larger in real terms, even while supporting the withdrawal. What makes this approach genuinely powerful and genuinely passive is the complete absence of active management requirements. There are no tenants to manage, no products to sell, no audience to maintain, no customer service, no operational complexity. The portfolio is invested in broadly diversified index funds which require minimal oversight. The withdrawal is a systematic preset amount transferred at regular intervals. The entire system, once established, operates largely on autopilot. The only meaningful challenge in this approach is the accumulation phase, building the portfolio to a size where the 4% withdrawal funds your lifestyle. This requires sustained, consistent investment over years and decades. But the accumulation process, regular contributions to broadly diversified low-cost index funds, is itself one of the simplest financial activities available. The discipline required is consistency, not complexity. The 4% withdrawal rate, sometimes called the safe withdrawal rate, is derived from extensive research on historical portfolio performance across multiple countries and time periods. The research consistently shows that a diversified portfolio of approximately 60% equities and 40% bonds could have sustained a 4% annual withdrawal across every 30-year retirement period in documented market history. For longer retirement periods, which increasingly apply given rising life expectancy, a slightly more conservative withdrawal rate of 3 to 3.5% provides additional safety margin. Matt Tellett Action. This week, calculate your own financial independence number. Estimate your annual living expenses at the lifestyle you want. Multiply by 25 to find the portfolio size that would support a 4% withdrawal covering those expenses. Write that number down. This is your target. Every contribution to your investment portfolio from this point forward is a step toward it. Digital products, effort-based, no capital required. Unlimited scale potential digital products represent one of the most genuinely accessible paths to passive income available, and one of the most frequently misunderstood. The accessibility is real. The passivity requires significant work before it becomes real. The model is built on a single powerful economic characteristic. Once a digital product is created, it can be sold to an unlimited number of buyers at essentially zero additional cost per sale. A physical product requires materials, manufacturing, shipping, and inventory management for every unit sold. A digital product, a course, an ebook, a template, a piece of software, a downloadable guide, is produced once and distributed infinitely. The economics of infinite distribution at zero marginal cost are genuinely extraordinary for creators who can produce something that people genuinely want to buy. The most important word in that last sentence is genuinely. The digital product space is saturated with low-quality content, produced quickly by people who have heard about passive income from digital products and are trying to capitalize on the concept without providing genuine value. These products do not sell or sell briefly before reviews and reputation damage their visibility. The digital products that generate sustainable, growing passive income over time are those that provide genuine, significant, specific value to a well-defined audience that has a real problem. Those products help solve. What this means practically is that the foundation of a successful digital product is real expertise or real experience in something that other people genuinely want to learn or access. This expertise does not need to be academic or credential-based. It can be practical, experiential, or skill-based, knowledge you have accumulated through your career, your hobbies, your personal experiences, or your professional practice. If you know something that other people want to know, and you can package that knowledge in a form that is accessible, clear, and genuinely useful, you have the foundation of a digital product. Think about a professional who has spent 12 years working in a specialized field and accumulated deep practical knowledge that is difficult to find in any structured form elsewhere. They spend 3 months creating a comprehensive course that packages everything they know into a systematic, accessible curriculum. They launch it to a modest initial audience, perhaps built through a social media presence or professional network. Early sales are modest, but as reviews accumulate, as the content proves its value, and as the product gains visibility through organic discovery, sales become consistent. The 12 years of accumulated expertise packaged once into a product continues generating income years after the creation work is done. The income is genuinely passive, but it was built on a foundation of 12 years of real knowledge and 3 months of intensive packaging work. The practical path to digital product income has 3 stages that must be respected in sequence. The first stage is building the knowledge asset, the genuine expertise or experience that will form the basis of the product. If you do not yet have this, developing it is the necessary first investment. The second stage is packaging that knowledge into a product form that serves a specific audience with a specific problem. This stage requires significant focused work, weeks to months for a comprehensive course or guide. The third stage is distribution, getting the product in front of the audience that needs it. This may involve building an audience through content creation, partnering with existing platforms, or investing in paid distribution. Each stage takes time. None of them is passive. What follows them can be the economics of digital products become compelling at scale, primarily because of the zero marginal cost of distribution. A product priced at $100 that sells 10 units per month generates $1,000 monthly with essentially no ongoing cost beyond whatever platform fee applies. At 100 units per month, achievable with the right product, the right audience, and sufficient distribution, The monthly revenue is $10,000 from the same product that required the same one-time creation investment. The scaling economics are genuinely powerful, but they apply only to products with genuine value that reach audiences with genuine need. Action this week. Identify one area of genuine expertise or experience you have accumulated, professional, practical, or personal, that other people would genuinely pay to access. Write down the specific problem that expertise helps solve and the specific audience that has that problem. This is the seed of a digital product. Research what already exists in this space and identify the gap your knowledge could fill. Content creation and licensing, effort-based, long build, long return, compounding library content creation is the passive income stream with the longest build time and the most commonly misunderstood economics. Most people who try to build income from content creation give up before they reach the point where the compounding effect of a content library begins to generate meaningful passive income. The fundamental model is this. Create content, videos, articles, photographs, music, podcasts that can be discovered, viewed, and consumed by an audience independently of your ongoing presence or effort. Each piece of content becomes an asset in your library. That asset can generate income through advertising revenue, subscription fees, licensing, or affiliate commissions, in many cases indefinitely. A video published 3 years ago continues to receive views and generate advertising revenue today. An article written 5 years ago continues to attract readers through search engines. A photograph licensed once continues to be licensed again without additional work. The compounding effect of a content library is the critical concept to understand here. In the early stages of content creation, each individual piece generates modest income, perhaps almost none at all. The audience is small, the library is thin, the discoverability is limited. This is the phase where most people stop, concluding that content creation does not work. But for those who continue, who build the library consistently over months and years, something changes. The library becomes large enough that individual pieces begin to be discovered through organic search and recommendation algorithms. The audience grows. The income from each additional piece is additive to a growing base. And the older content still being discovered and consumed continues contributing to income that now requires no additional effort to maintain. Consider two content creators who start on the same day with the same level of initial audience, which is to say essentially none. The first publishes consistently for 3 months, sees negligible income, concludes it is not working, and stops. Their content library at that point contains perhaps 15 pieces, none of which has had enough time to build significant organic discovery. The second creator commits to a genuine 2-year building period before evaluating the income potential. By the end of year 1, the library contains 50-plus pieces. Organic discovery is beginning, and monthly income, while still modest, is growing. By the end of year 2, the library has crossed a critical mass threshold. There are enough pieces, with enough accumulated views and engagement, that the discovery algorithm is consistently surfacing content to new audiences. Monthly income is now genuinely meaningful and growing without a proportional increase in creation effort. The two creators had identical starting points. The difference was entirely in the willingness to build through the non-passive phase long enough for the passive phase to begin. The specific platform and content type matter less than most people think. YouTube, written content, podcasting, photography, music. Each has a different discovery mechanism and a different income model. But the fundamental dynamic is the same. Build a library of genuinely valuable content. Reach an audience that finds it valuable. Build enough of a library that discovery becomes organic and self-sustaining. The income follows the audience. The audience follows the content. The content requires consistent creation over a sustained period before the compounding takes hold. Research on content creator income consistently shows that the majority of total lifetime income from any given piece of content is earned not in the week of publication, when promotional effort is highest, but in the months and years that follow, as it is discovered organically through search, recommendation, and sharing. This is the compounding library effect in practice. Older content in a well-maintained library often outperforms newer content in absolute income terms, because it has had more time to be discovered and shared. The income from content creation is backloaded. The effort is front-loaded. Most people stop during the front-loaded effort phase before the backloaded income begins. Modella action. This week, identify the content format that aligns most naturally with your existing skills, knowledge, and preferences. Video, written content, audio, or visual. Choose one platform to focus on initially, rather than spreading across several simultaneously. Create your first piece of content and publish it. Then commit to a publishing schedule you can genuinely maintain for the next 12 months, not the most ambitious schedule possible, but the most consistent one. Consistency over 12 months beats intensity over 3 months every time. Affiliate income, trust-based. Built on credibility, affiliate income has a deceptively simple model and a critically important foundation requirement that most people who try to build it either underestimate or ignore entirely. Get the foundation wrong and the income never materializes. Get it right, and it can be one of the most sustainable passive income streams available. The model: you recommend a product or service to an audience that trusts your recommendations. When someone from your audience purchases through your unique referral link, you earn a commission, typically a percentage of the sale price. The income arrives without you needing to create the product, manage customer service, handle fulfillment, or deal with any of the operational complexity of running the actual business. You simply connect people with products that genuinely help them and earn a portion of the revenue that results. The critical foundation requirement is trust, and not surface-level trust, the kind that comes from a polished presentation and confident delivery. Deep, demonstrated, earned trust, the kind that is built by an audience that has followed you long enough to know that your recommendations reflect genuine experience and honest assessment, rather than whoever is paying the highest commission. The affiliate income model fails, and fails consistently and expensively, when the foundation of trust is absent or corrupted. Recommending products for commission rather than genuine value. Recommending things you have not personally used or verified. Recommending whatever affiliate program pays the most, regardless of product quality. These approaches generate short-term commission income at the cost of the audience trust that makes the entire model function. And once that trust is damaged, once your audience perceives that your recommendations are commercially driven rather than genuinely helpful, rebuilding it is extraordinarily difficult. The affiliate income approach that works, that generates sustainable, growing commission income over years, rather than a short burst followed by declining audience engagement, is the one where the affiliate relationship is genuinely secondary to the value being provided. Where recommendations are made because the product genuinely serves the audience, and the commission is a consequence of that genuine recommendation rather than the motivation for it. This is not just ethical advice, it is practical advice. The most successful affiliate income builders are those whose audiences trust them completely, and that trust is built by consistently prioritizing audience value over commission revenue. Think about two content creators building affiliate income simultaneously. The first approaches it primarily as a revenue strategy, researching which products pay the highest commissions in their space and building content around promoting those products. Initial commissions are decent, but over time, the audience notices that recommendations correlate suspiciously with commission rates rather than genuine product quality. Engagement drops. Recommendations are increasingly ignored or questioned. Income from affiliate commissions declines as trust erodes. The second creator builds affiliate income as a natural extension of genuinely valuable content. They recommend only products they have personally used and genuinely believe in. Their audience knows this. When a recommendation appears, it is acted upon with high confidence because the track record is consistent. The conversion rate on their recommendations is significantly higher than the first creators, not because they have a larger audience, but because their audience trusts them completely. Over time, this trust-based approach generates more income from a smaller audience than the commission-first approach generates from a larger one. Conversion rates. The percentage of audience members who purchase a recommended product vary dramatically based on audience trust. A highly trusted creator with a modest audience consistently outperforms a less trusted creator with a much larger audience in total affiliate income. This is because trust determines the degree to which recommendations are acted upon. Building deep trust with a smaller audience produces better affiliate income outcomes than building shallow reach with a larger one. Quality of relationship, not quantity of followers, determines affiliate income effectiveness. Module action this week. Identify the products and services in your area of expertise or content that you genuinely use, genuinely value, and genuinely believe would benefit people in your audience. Research the affiliate programs these products offer. Apply only to programs for products you would recommend even without the commission. Build the recommendation practice from a foundation of genuine belief and let the commission be the consequence of that, not the motivation for it. A business that runs without you, systems-based, highest ceiling. Most demanding to build the seventh and most powerful passive income stream is also the most demanding to build, and the one that requires the clearest understanding of what it actually is, and is not before you decide whether to pursue it. A business that runs without you is not just a business that you own. Almost every business owner owns their business, But most business owners are also their business's most essential employee, the person without whom the business stops functioning. That is not a passive income business. That is a job that you own. The distinction is critical. A genuinely passive income business is one with documented systems, trained people, established processes, and a management structure that allows the business to generate revenue, serve customers, and continue operating at a high standard without your daily presence. Your role transitions from operator to owner, from being inside the machine to overseeing it from outside. This transition is the hardest and most important thing to build in any business intended to generate passive income. Building this type of business begins with building a successful business in the traditional sense, creating a product or service that the market wants, building the customer base, generating the revenue, developing the operations. This phase is intensely active. It is demanding, uncertain, and often consuming, but it is the prerequisite. You cannot systematize and delegate a business that does not yet exist and does not yet work. The systematization phase, the phase that converts an active business into a passive income source, involves documenting every process so that it can be performed consistently by someone else, training the right people, building the management layer that makes decisions in your absence according to principles you establish, creating the reporting systems that allow you to oversee performance without being operationally involved in creating it. This phase takes longer than most people expect and is harder than most business building content suggests. The result, a business that generates meaningful revenue without requiring your daily operational involvement, is one of the most powerful financial positions an individual can reach. It provides the income of a successful business with the time freedom of not being operationally constrained by it. But the path there is long, demanding, and uncertain in a way that the other income streams on this list are not. There are no guarantees. Many businesses never successfully make the transition from operator-dependent to genuinely systematized. Understanding this before you begin is essential. Think about two business owners with comparable businesses at a similar revenue level. The first owner is the business. They are in it every day. Every decision runs through them. Every important relationship is theirs personally. The business is profitable and growing, but it generates income only when they are actively working. If they stop, the business stops. The second owner has spent 5 years systematically documenting processes, hiring and training the right people, building management capability, and establishing reporting systems that give them visibility without requiring operational presence. Their business now runs effectively without them. They step back, the revenue continues. The income, once dependent entirely on their daily presence, now arrives largely independently of it. Both businesses look similar from the outside. Inside, they are fundamentally different financial assets. The transition from an operator-dependent business to a genuinely systematized business that generates income independently is achieved by a minority of business owners, and typically takes 5 to 10 years from the founding of the business to complete. The primary reason most businesses do not make this transition is not lack of profitability, but lack of deliberate systematization. Business owners who do not consciously build toward the transition, who do not actively document, delegate, and develop the management layer required, remain operationally trapped regardless of how successful their business becomes in revenue terms. Action. This week, if you own a business or are building one, identify the 3 most critical processes that currently depend entirely on your personal involvement. Document the first one in sufficient detail that someone else could perform it to your standard. This is the beginning of the systematization that eventually makes the business a genuine passive income asset rather than a job you own. Final message: 7 income streams. 7 genuine paths to income that does not depend entirely on your direct ongoing daily labor. Each one real, each one achievable, each one requiring either capital, sustained effort, or both, and none of them delivering meaningful passive income faster than the time and resources invested in building them justify. Dividend investing, the most reliable and most scalable capital-based stream, built on consistent contributions and compound reinvestment over a long time horizon. Rental property, powerful through leverage, demanding through management, requiring more capital and more active involvement than most people expect. Index fund portfolio withdrawals, the most truly passive stream for those who have built the capital base, using the total return approach to fund living expenses from a growing portfolio. Digital products, the most accessible effort-based stream, built on genuine expertise packaged once and distributed infinitely, requiring significant upfront creation before the passive phase begins. Content creation and licensing, the longest build with the most powerful compounding library effect, requiring years of consistent creation before the income becomes meaningfully passive. Affiliate income built entirely on audience trust. Sustainable. Only when recommendations are genuinely in the audience's interest, rather than primarily in the creator's financial interest. And a business that runs without you. The highest ceiling and most demanding path, requiring years of systematic building before the income genuinely operates without your daily presence. The most important thing I want you to take from this video is not which stream is best. There is no universal answer to that question. The best stream for you is the one that matches your current resources, the capital you have or can build, the expertise and skills you already possess, the time and energy available for the building phase, with a realistic expectation of what that stream requires and how long it takes. Match your resources to the right stream. Build it with accurate expectations. Sustain the effort or capital accumulation through the non-passive phase, because every passive income stream has a non-passive building phase, and most people stop during it. And give the system the time it needs to compound into something genuinely meaningful. Passive income is not a shortcut to wealth. It is the result of playing a patient, deliberate, long game with whichever stream fits your situation best. The people who build it successfully are not those who found a faster path. They are those who understood the real path clearly enough to stay on it, long enough for it to deliver. Start one stream, build it up properly, let it grow, then build the next. If this video gave you a clearer, more honest picture of what passive income actually requires and what it can actually produce, please share it. The most useful thing you can do for someone chasing passive income is give them accurate expectations. Subscribe to our Financial Edge for a new video every single week and leave a comment below. Which of the 7 streams are you most focused on building right now? I read every single reply. See you in the next one.